For many organizations, the money involved in the revenue cycle is generated through sales. This involves a four-step sales transaction cycle: processing orders, checking credit, shipping goods, and finally billing and recording. Auditing the sales transaction cycle also involves four steps. First, the auditor lists all the transactions related to the audit objectives, then examines internal controls. Third, the auditor must perform tests before finally reporting the conclusions of the audit. When auditing the sales transaction cycle, or any element of the revenue cycle, an auditor is mainly interested in controls that ensure all revenue transactions that actually occurred are authorized and are recorded accurately. There are 5 audit objectives that make up the framework for verifying this: occurrence, completeness, accuracy, cutoff, and classification. Auditing a sales transaction cycle is a 4-step process. Having finished listing transactions related to audit objectives, the auditor's attention will switch to the second of those steps: internal controls. The auditor needs to observe the procedures and processes that help control risks associated with each audit objective. This will help the auditor understand and examine internal controls. For an internal control procedure to be effective, there are 5 principles that must be rigorously observed. The first principle is separation of duties, and the second is authorization. The third principle is documentation and record keeping, while the fourth is control over assets and records. The fifth and final principle for making the internal control procedure effective is independent checks. The first principle for making internal controls effective is separation of duties. This principle aims to safeguard against fraud. For instance, whoever is inputting sales and payment data into an organization's computer system should have no physical access to that payment. Whether the payment is by cash, check, or by electronic banking, this separation of duties must be present. Consider this example. Peter has been asked to audit the revenue of an electronics manufacturer. During the audit, he observes that a procedure is in place to ensure the person responsible for producing sales invoices is different from the person who processes payments for the relevant sales. The second principle of making sure internal controls are effective is authorization. An auditor must ensure that internal control procedures specify how credit, pricing, and shipment are authorized. The auditor needs to check that the credit extended to each client is authorized by the proper individual or department. The pricing of all goods, as well as any discounts, and shipping must also be authorized. For example, Stephen finds out that the proper authorization is in place for client credit checks. They're only approved after a relevant financial institution sends an official document confirming the client's credit capabilities. Greg is auditing the sales transaction cycle of a gym equipment supplier. He wants to understand the organization's internal control. The third principle for making internal controls effective is documentation. Different companies have different methods of documenting sales. However, controls must be in place ensuring all sales invoices and shipping documents are recorded. It's important that all these documents are numbered in sequence. If each sales invoice, shipping record, and other documents have a specific reference number, records of sales occurrences will be kept in order, and any missing documents can easily be spotted. In the case of the steel beam manufacturer, Stephen observed that adequate record-keeping procedures are in place. The organization's documentation controls include numbered sales forms, open order files, shipping order files, standardized sales terms, and bills of lading. The fourth principle of making sure internal controls are effective is control over assets and records. This includes physical safeguarding of assets, including inventory, money, records, and IT systems. Physical storage can mean a variety of safeguards are utilized. This could include storerooms, safes, locks, and the requirement of personnel identification for access to buildings. Effective fire extinguishing systems must also be present. Organizations must also protect electronic assets and records. Similar to what you do with physical goods, ensure that controls are in place for these systems to run correctly. For instance, copies of all electronic records should be backed up at an off-site location. Also, on a day-to-day basis, all electronic data should be password protected. The steel beam manufacturer that Stephen is auditing keeps its warehouse inventory under lock and key. The organization's security coordinator tells him that checks received through the mail are kept in a fireproof safe. All electronic data is backed up and stored on an off-site server. Ensuring effective control over assets and records involves correctly numbering all documentation related to the sales transaction cycle. Is this statement true or false? The fifth and final principle involved in making sure an internal control procedure is effective is independent checks by individuals or systems. This provides an extra layer of verification to check whether the internal control procedure has been properly performed. An independent individual or system examines the internal control procedure to make sure it's running as the organization wants it to. For instance, it's better that the person examining the bank records of an organization isn't involved in other areas of accounting records or cash handling, and so is independent from those duties. Then the assessment of the organization's bank records can be objective. Computer systems are also used as an extra layer of protection. A system may be in place that won't accept a cash receipt entry from a customer if the corresponding shipping order is not matched to the payment being entered. In the case of the steel beam manufacturer, the organization performs an end-of-month check on cash payments and sales invoices. A member of the finance department tells Stephen that the organization always ensures this check is both independent and objective. This duty is outsourced to an accountant who is not involved in any other accounting actions within the organization. Remember Greg, who's auditing the sales transaction cycle of the gym equipment supplier? What will Greg be looking for to confirm internal control procedures are effective? Auditors use three tools to get an understanding of internal control procedures: narratives, flowcharts, and questionnaires. Once auditors get an understanding and a clear idea of the internal controls in place, they can examine these procedures by checking whether the 5 principles that ensure their effectiveness have been implemented. A narrative is a written description of an organization's internal controls. The narrative should first explain the origin of all documents within a company's computer system. It should also describe all the processing that takes place. For example, if sales invoices are automatically sent to the company accountant, this should be noted. and the narrative should clearly state the destination of every document, physical or electronic. Whether the document is stored in a filing cabinet or a computer drive, or even destroyed, this must be described in the narrative. Take the example of Eric, who's auditing a publishing company. To understand internal controls in place, he writes up a narrative of the organization's sales transaction cycle. Eric begins by noting that all documents related to magazine delivery and reseller payments originate in the sales team's New Sales folder. This folder can be accessed by the finance department, which processes these sales orders. Narratives are focused on highlighting improvements that can be made to internal controls. Is this statement true or false? Whereas a narrative describes an internal control process in words, a flowchart aims to describe it in diagrams. Using such diagrams, flowcharts map the progress of client and internal documents, pointing out where they flow to within the organization and outside it. Flowcharts provide a concise overview of the documentation systems in place within an organization. They help auditors analyze the system through which transactions are noted, processed, and shipped. Flowcharts also highlight where improvements can be made. For instance, if the flowchart shows shipping orders are being generated too early, this can be rectified. Stephen is designing a flowchart for the steel beam manufacturer. This diagram begins with the creation of customer order sales forms. These forms are then subdivided between numbered forms for orders under 2,000 tons and orders over 2,000 tons. Orders up to 2,000 tons have open sales order files generated after being inputted into the system. Orders above that size are handled by the sales manager, who then creates open sales order files. All orders less than 2,000 tons go through an automated credit check. Sales orders over 2,000 tons are sent to the finance department to be investigated for the creditworthiness before approval. Following credit checks, all orders generate a sales invoice and are sent to the same system folder. They are then checked by the company's shipping department, which confirms if orders are ready. Once this happens, the sales invoices are matched with shipping orders in a new folder. After shipping, sales over 2,000 tons are placed in a high-value folder of the general ledger, with those under that amount placed in a separate, lower-value ledger folder. What are examples of flowcharts being used correctly to identify inefficiencies in the sales transaction cycle? The third tool used by auditors to examine and investigate internal controls is questionnaires requiring yes or no answers. Through these questions, auditors can determine which transactions related to audit objectives are effectively controlled and which are not. Each area of an audit can be covered in detail with specific questions. To achieve this, each transaction related to audit objectives is subdivided into several questions. For example, imagine looking at completeness of sales transactions during a sales transaction cycle. The yes or no questions could include, are records of shipments maintained? And are all shipping documents numbered? And are sales invoices accounted for? In Stephen's case, he created a questionnaire for the steel beam manufacturer's sales department and finance department. Questions include whether orders under 2,000 tons are subject to adequate credit checks, if shipping orders are generated automatically after confirmation of stock, and whether all transactions are recorded in the general ledger. Remember Greg, who's auditing the sales transaction cycle of a gym equipment supplier. He wants to investigate and examine the internal controls of the organization during his audit. What actions should he take? An auditor will usually use either a narrative or flowchart in conjunction with a questionnaire to help investigate and examine internal controls. Whichever combination is chosen, the information gathered must be presented by the auditor in a coherent fashion. This is best achieved by using a matrix. The rows of this matrix will show various internal controls listed. These can include controls such as sales transactions being verified internally, or credit being approved automatically following comparisons with authorized credit limits. The columns will then list the audit objectives: occurrence, completeness, accuracy, cutoff, and classification. Each internal control procedure is examined by verifying that the principles of separation of duties, authorization, documentation, control over assets and records, and independent checks have been implemented. Strong controls are marked with a plus symbol, and poor controls are marked with a minus symbol. In certain instances, objectives are not affected by a particular control, and so NA is used to denote non-applicable. For Stephen, in the audit of the steel beam manufacturer, each of the questions in his survey assesses an internal control procedure. Having received the results of the survey, he uses them to create a matrix. He matches the controls with the audit objectives of occurrence, completeness, accuracy, cutoff, and classification. Select each internal control in Stephen's matrix to find out if it met each. Stephen finds occurrence is met as the credit check indicates an actual transaction took place requiring the credit check of a real counterparty. Completeness is met as total values of merchandise sold can be compared to that shipped. Accuracy isn't confirmed, as values of merchandise aren't independently recalculated. Cutoff is not met, as credit checks aren't time-stamped. Classification is met, with orders under 2,000 tons sent electronically, while those over 2,000 tons require proper approval. Shipping of orders generated automatically meets occurrence and completeness objectives, as there's no other intervention in the system between the credit check approval stage and the generation of shipping orders. However, accuracy and cutoff are not met, as the information flowing from the prior step is not time-stamped or checked for mathematical errors. The classification objective is met, as orders remain in the under 2,000 tons category. In the case of this control, Stephen finds that occurrence and completeness are met as all information from the prior step flows to the general ledger. Meanwhile, accuracy is met as an independent accountant recalculates all the values charged to clients and confirms these with the values recorded in the general ledger. Cut-off is not met, as the transactions were never timestamped. Also, classification is not met, as transactions under 2,000 tons are filed alongside those over 2,000 tons. With his matrix complete, Stephen can now move on to the second half of auditing the sales transaction cycle. This involves performing tests and reporting conclusions to the owners of the steel beam manufacturer. For internal controls to be effective, they need to demonstrate that 5 principles in particular are being implemented. These principles are separation of duties, authorization, documentation, control over assets and records, and independent checks. To understand and examine these internal controls, auditors use narratives, flowcharts, or questionnaires. The outcomes of internal controls examination should then be compiled into a matrix to gain an overview of internal controls related to the audit objectives. The process of auditing the sales transaction cycle involves 4 key steps. Auditors first create a list of transactions related to audit objectives, and then examine internal controls. The third step is for auditors to design and perform tests. And finally, they report their conclusions. In the third step, auditors perform 2 categories of tests. These are the tests of controls and substantive tests. Select each category of test to learn more about it. Tests of controls focus on the effectiveness of an organization's internal controls. These tests help suggest areas for improvement and highlight inefficiencies. For example, if one control states that shipping documents should be numbered and accounted for weekly, you should test whether this actually happens. Take a sample of 1 week's shipping documents to see if all relevant documents are present and numbered. Substantive tests focus on ensuring there are no material misstatements in the sales transaction cycle. These tests evaluate whether an organization has correctly recorded the details, and in particular, the monetary details of a transaction. For example, you could take a sample of the final sales prices for an organization's electronics shipments. Then test whether sales have been invoiced and recorded at that price. Tests of controls and substantive tests are used by auditors to determine whether an audit objective is being met. These objectives are occurrence, accuracy, completeness, cut-off, and classification. For example, Stephen has been asked to audit the revenue a manufacturer generates from the sale of steel beams. He begins by using tests of controls to check the effectiveness of internal controls related to the objective of occurrence. In terms of occurrence, one test Stephen uses is to examine whether monthly statements are sent to customers. This internal control would give customers the opportunity to alert the company to any errors in the monthly statements. Stephen tests this internal control by observing the actions of the billing department. He notices that there's no proof monthly statements are actually sent. He concludes this internal control doesn't help him determine whether the objective of occurrence has been met. So, to check whether transactions actually occurred, he chooses a sample of steel beam orders to perform a substantive test. For this test, the auditor will inspect supporting sales documents like invoices to confirm that the sales did in fact occur. Match the auditor actions with the type of tests they represent. Each form of test may match more than one action. Both tests of controls and substantive tests can become vital parts of auditing the sales transaction cycle. However, deciding whether to use one test or the other, or perhaps even both, requires an initial risk assessment. This assessment determines the level of risk related to internal controls, and in turn, the tests best suited to help assess them. When the auditor first tries to understand the internal control system in question, he gathers evidence of its effectiveness and either decides risks involved in the sales transaction are at a maximum level or they're below maximum level. This decision then determines which of the three possible test strategies will be used. The first test strategy relates to when risk is at a maximum level. In that situation, only substantive tests should be conducted. When risk is at a maximum level, it means that internal controls are not working or are non-existent. In such cases, no tests of internal controls will be conducted. With the controls not working, testing them would be pointless. Instead, an auditor will opt to perform substantive tests only. For instance, Aaron is auditing the sales transaction cycle of a furniture manufacturer. His general assessment notes the organization doesn't have a process for comparing shipping documents to sales invoices. Related to the occurrence objective, this ensures customers receive what they're paying for. Aaron discovers this never actually happens, and he assesses the internal control risk for this objective as being at a maximum level. Aaron uses substantive tests on a sample of sales to examine whether any material misstatements have occurred. The second strategy relates to when risk is assessed below maximum level. In that situation, both substantive tests and tests of controls should be conducted. Whereas the first strategy applies when internal controls aren't in place, the second strategy applies when the controls are in place and are somewhat effective. If the auditor deems that the internal control is at least somewhat effective, tests of controls are carried out to decrease the need for substantive testing. If tests of controls determine that controls are strong, then substantive tests are performed at a low level. However, if tests of controls indicate weaknesses, then substantive tests are performed at an extensive level. Take the example of Jessica, who's just made a general risk assessment for her audit of an art supplies business and decides risk is below maximum. When she conducts tests of one control, the separation of duties between recording sales and handling of sales-related cash, it shows vulnerabilities, despite previously being assumed to be somewhat effective. Concerned by this, Jessica carries out extensive substantive tests for this control. Match the examples of auditor actions with the level of risk associated with an internal control. The third test strategy states that if the control risk is below maximum and there's already enough evidence to determine internal controls are effective, then only a minimal number of substantive tests may need to be conducted. In these cases, no tests of controls are required because the evidence has already been gathered to conclude that internal controls are effective. Take the example of Eugenia, who's auditing the sales transaction cycle of an educational book publisher. Eugenia sees from the beginning of her audit that there's enough company data to support the idea that all internal controls are functioning. For instance, one internal control is that the organization's computer system automatically posts transactions to an accounts receivable record. The fact that the accounts receivable record confirms this takes place means Eugenia doesn't have to perform tests of controls in this case. Instead, Eugenia carries on her assessment of the computer system by preparing substantive tests related to sample transactions. Kevin is currently auditing the sales transaction cycle of an MP3 player manufacturer. He notes that a current sales order shows the organization is sending a shipment of 10,000 units to a major electronics retailer. Kevin is looking at the company's internal controls and is paying specific attention to whether batch totals of quantities shipped match up to quantities billed. A general risk assessment of this internal control has shown that controlled risk is below maximum. Evidence has been obtained that the internal control is functioning effectively. What testing strategy should Kevin employ in this situation? Having assessed levels of risk related to internal controls and decided on the appropriate tests to carry out, an auditor's focus turns to results. The four-step process of auditing the sales transaction cycle ends with reporting the conclusions arising from the auditor's findings. Remember Stephen, who's auditing the sales transaction cycle of a steel beam manufacturer. In Stephen's case, he's been following the four-step process for his audit. More generally, what benefits can be reaped from following this process? Now Stephen must prepare for the final step of auditing the sales transaction cycle, reporting the conclusions arising from his findings. He has already gathered financial data, questionnaire answers, and technical conclusions on internal controls. However, these findings must now be communicated to management. Auditors use two types of letters to do this: reporting condition letters and management letters. Reporting condition letters are a formal method of communicating audit findings, highlighting issues arising from the audit. The auditor's understanding of internal controls, including strengths or weaknesses, will be part of these letters. For instance, you may have audited your company's sales transaction cycle and noted several findings. Perhaps a computer-based comparison system used to approve client credit is prone to error. In such cases, your reporting condition letter details these errors and asks management to give it immediate attention. In addition to reporting condition letters, auditors will often communicate other related matters via a management letter. In this letter, auditors may address internal control issues and make suggestions on improvements. Having carried out similar audits in the past, the auditor may know of opportunities for the client to improve operational weaknesses. For instance, if your audit of the sales transaction cycle showed your organization would benefit from incorporating a new internal control, this would be addressed in a management letter. Match the examples of communicating the results of auditing the sales transaction cycle with the appropriate letter used for them. Each type of letter may match to more than one example of communication. As Stephen completes his audit, he decides to communicate his findings using both a reporting condition letter and a management letter. He addresses his findings to an audit committee created by the steel beam manufacturers board. In his reporting condition letter, Stephen indicates that verification that batch quantities shipped match quantities billed only occurs 70% of the time. This, he says, is of great concern, as shipments may be made without transactions being recorded. This would in turn cause misstatements in the net revenue and accounts receivable values. The audit committee thanks him for this finding and intends to take action in this respect. As Stephen is only noting this problem rather than suggesting a solution to it, this is placed in the reporting condition letter. Stephen also prepares a letter to management in addition to his reporting condition letter. This document points out that internal controls regarding the objectives of occurrence, completeness, and accuracy would be greatly improved by ensuring that the company sends monthly statements to its clients. This idea can, he argues, potentially help to identify errors and omissions which could be significant. Pointing toward examples of organizations where this control is enforced, he shows it can be successful. Stephen's findings are then taken on board by the steel beam manufacturer's upper management. With his audit complete, the organization uses his conclusions to address several issues with the sales transaction cycle. What are examples of auditors using a reporting condition letter or a management letter correctly? Once auditors have listed transactions related to audit objectives and examined internal controls, they should move to the third step of designing and performing tests. These tests can either take the form of tests of controls, or they can be substantive tests. To determine the most appropriate test strategy, an auditor first makes a general risk assessment of internal controls. This helps decide if internal controls risk is at a maximum or alternatively below maximum. To communicate the auditor's findings, two types of letters are used: reporting condition letters and management letters. Reporting condition letters communicate the findings of an audit. Meanwhile, management letters suggest solutions for issues that arose during the process of auditing the sales transaction cycle. Elsa is an auditor with a